The rupee fall past the rupee 90 per US dollar mark on December 3, 2025, prompting debates on whether the sharp depreciation reflects a market meltdown or a deliberate policy shift by the Reserve Bank of India. Market forces driving the rupee's decline. The rupee's movement is shaped by a combination of external shocks and domestic economic behavior. Three major market developments have intensified pressure on the currency. Tariff-induced export slowdown. The 50% tariff imposed by the US, India's largest export destination, has made Indian goods significantly more expensive. Export to the US fell 12% in September and 9% in October 2025, dragging overall monthly exports down by nearly 12% year-on-year. The fall in demand meant exporters earn fewer dollars, contributing to a dollar scarcity and pushing the rupee lower. A 0.5% increase in cumulative export from April to October 2025, showing that exporters partially compensated through other global markets. Nevertheless, forward-looking indicators such as the manufacturing PMI and new export order sub-index are at their lowest in months, suggesting deeper export stress in the coming period. Surge in gold and silver imports. Gold imports surged by 200% to $14.7 billion and silver imports jumped 5 to 8% to $2.7 billion in October. Although festive demands played some role, economists call this a flight to safety, a reaction to domestic financial volatility. To buy billion, domestic players sold rupees to purchase dollar, adding to exchange market pressure and worsening the trade balance. This import surge became a major driver of the rupee depreciation. Record foreign portfolio investor outflows. FPIs have withdrawn $17 billion from Indian equity markets in 2025, the largest outflow in 2 decades. When FPIs exit, they sell rupees and buy dollar, accelerating the rupee's fall. The scale of outflows is comparable to global distress years such as 2008 and 2022. Understanding RBI's strategic shift. While market factors exert pressure, the rupee's actual value also depends heavily on the central bank's intervention stance, from aggressive defense to limited intervention. Between 2022 and 2024, the RBI sold enormous amounts of foreign reserves, over $30 billion in Q3 of 2022 and $38 billion in Q4 of 2024 to prevent sharp depreciation. However, in 2025, despite comparably adverse conditions, RBI sold only $10.9 billion in Q3. This signals a pivot away from protecting a fixed exchange rate. Economists call this a managed flow strategy. The RBI is no longer fixing the rupee at a particular level but smoothing volatility while allowing depreciation. RBI's calculated bet on a weaker rupee. RBI appears to be betting that a gradually weaker rupee can act as an economic shock absorber. It could make Indian export more competitive, partly offset tariff losses and prevent excessive reserve depletion. Experts support the strategy. If executed slowly, gradual depreciation allows firms time to renegotiate contracts and adjust supply chains. A sudden 50% fall would be disruptive. However, they also offer a caution: a weaker nominal rupee does not automatically translate into a competitive real exchange rate, especially if domestic inflation is high. Historically, India saw nominal depreciation without export gain post-COVID because domestic costs rose faster. Weak US demand may blunt any benefit from the rupee's fall, a balancing act between risk and resilience. The rupee slide reflects a mixture of global shocks, domestic behavior shifts, and a strategic central bank recalibration. While India faces near-term risks such as rising import bills, volatility in investor sentiment, and uncertain export recovery, the deliberate moderation of forex interventions indicates confidence in the currency's ability to seek a stable market level over time. The coming month will test whether the RBI's approach can stabilize macroeconomic pressure without triggering financial instability.